So let's have a look at this slide, because this slide, I believe, is probably one of the most important slides of this particular show tonight. This is the pictorial history in writing, in numbers. So there's your happy days, the new pivot, rampage, carnage, etc., right through to the question mark at the end on the right-hand side. Look at those numbers on the second line. Happy days, 31.5%. That's buying the S&P index. That's fantastic. And even with the drama that happened in 2020, you can see COVID-19, officially 16th of March. On that day, those three major bellwether indices dropped by those percentage points. And if you had that today, and we've lived through that, we came through it, we're still here, we're still breathing and investing. And overall 34% in 1 week. And what we saw, as I mentioned earlier, was the rise of technology, the adoption and the adaptation of the future into sectors that had been slumbering before then. And certainly the allocation of growth stocks to our underlying baskets in that space worked very well. So Cashbox as a company was very orientated during the happy days and the new pivot, if you want to call it that, in conditional income and in growth stocks and underlying stories. Very strong, lots of order calls, because we were coming off this very low base. So typically, buying in low, and the old adage is sell high. We were forced sellers because that's what the terms and conditions happen. The rampage, there you saw your hangover, those supply chain blockages of businesses trying to get going again. Interest rates were slashed. Governments were very accommodating in terms of take out debt, let people try and keep going, try and keep the economy moving. And so it was growth drivers. We need to grow, and that's what happened. At low interest rates, people took wonderful opportunities to recapitalize their businesses, do M&A. CapExing was fantastic. We can get all new stuff. We don't have to repay anybody. But there were challenges like the disruptions in supply chain. That was probably one of the biggest ones. You must understand that China was the supplier. Made in China was the supplier to the world, and they were continuously in various lockdowns and spikes. So there were those problems. But 28.7% return, not too far off the happy days of 2019. And then going into carnage, where at the end of 22, we were down minus 18% on a portfolio. And that's the only red number there. And that was a decline. It wasn't just the States. It was a decline globally, wherever you were living. And I know we've got people from all 4 points of the compass on the call tonight. And it was overheated, declined stocks. And that's when, as I mentioned, in March 22, in the US, by way of illustration, the rates started moving up. And obviously the Ukraine, on I think it was February the 24th, Russia decided to go marching in with its jackboots into Ukraine. And that's caused our first energy crisis in Europe. Were you going to heat or were you going to eat, etc. Who was going to get pulled into this war? And it was the worst year since 2008. Interestingly, the markets up until now has moved in sort of 7-year increments. In 2000, the year .com, we had a bit of a downward. We had a big downward spike. 2008, we had another spike. And then obviously in 2020, we had that short downward spike. So kind of every 7 years. I'm not saying it's going to happen every year. I'm just saying I looked at those numbers, but that's quite interesting. Carnage. 2023, obviously the rate hikes were carrying on. Those 11 came through. But towards the end of 23, obviously we hit that so-called plateau. We were at the top of the hard medicine being taken. Everybody's saying, right, things are going to start cooling down in the States. The housing and employment figures need to come down. But USA Incorporated is quite resilient, and it's proved this year that they're not coming down as quickly or in a straight or in the line that the Federal Reserve would like it to. But inflation has eased. The lid's on the pot, but it's still bouncing around a little bit. But they have got the bubbling, the overflow, I think, largely contained. And that's when the obsession came with this, when we're going to have cuts, because everybody sees that as the universal panacea to equity forecasts. 2024, obviously we've got the Middle East conflict, which is carried over from last year. The Ukraine's still going along as well. Sticky inflation, I've mentioned, it's there. It hasn't gone down. There's certain metrics in the States that are actually going up, which is a worry. And the big mantra is now, okay, guys, the rates are going to stay longer for higher. So last year, during the obsession times, with rates going up, there's certain sectors that benefit from this. And we're going to show you which sectors benefit and which don't. And we started putting in. We actually started in 22, but 23 we were very strong on guaranteed income. So moving a little bit away from growth, where you normally get slightly higher coupons, moving to, let's say, well, it's not conditional, it's not growth. We want 12% in US dollars, for example, 10%, 12%, but we will give up, the upward growth and whatever it might be. So you have to buy, when you talk to the bank, you need to buy, if I can call it that, you need to negotiate. We'll take a lower figure than, let's say, an unconditional growth note, which we're floating around at 16, 18%, but we want something guaranteed. We know every quarter it's going to arrive without any conditions not having to be met. So that was very popular. 2022 was an interesting year because there was this transition from high growth to carnage, and we also produced what was called the hybrid notes, which was a little bit of both sides of the equation of payoff. So we had a note would have some component that had growth returns, and it would also, in the same component, have an income return which would be paid on maturity or auto call. So we started playing around, and I think also what's interesting, and Jill will allude to it in her couple of slides, is that as we've moved down this timeline, the notes are becoming more and more, I would say, consumer friendly from a protection perspective. We're adding in more and more overlays for consumer protection, capital protection at the end of the day. And you'll see that by the number of features that get built into each one. Now, those features actually cost somewhere along the line. The bank says, well, if you want these extra protective features, it's got to come from somewhere. When I say cost you, it comes out of the ultimate coupon. So the shape that you generally see at the end, we might have had a different outcome or payoff had we not had, let's say, a step down auto call or a knockout trigger or this feature or that feature. So very simple structures, you can get a higher return, but you don't have as many additional enhanced features for capital protection. And I think as we move into a nervous world, an unknown world, it's a little bit like that murky 2020 again, in terms of if any of these areas kick off geopolitically, or if there's an economic, collapse somewhere. We're taking that more and more into consideration. And to the degree that at the end of 23, we came with our first full capital protected note underwritten by one of the strongest banks in Canada, where people said, look, I'll even take 6 or 8%, but I want my capital protected irrespective of what happens. Okay, the sole caveat being the bank has to be in business. Okay, so that was where we arrived in 2024. And as I mentioned, starting off, we produced 2 notes this year. Now, if we go quickly to the third note, we can come back to this. This is a picture many of you will say, oh, what's that? Fat cat with a cigar and lots of dollar signs. It's exactly that. Investment banks, I always say, are not charities. You've all heard that. I've worked for them, I understand them. So I've got perhaps the credibility to say that. They will look to make money for the bank. That's their job, for the holding group. And at the moment, the returns and the pricing that they're giving us is pretty much skewed in their favor if they are wanting to actually even underwrite anything. And what I mean by that is that it all comes down to timing. And I think let's just jump into the next slide, because this is really not the fight, but these are the robust discussions we have. So on the right-hand side, AI generated very interesting looking analyst, big 5 considerations. So these are actually my considerations when I look to say, what note can we put into the community? Never mind what it's going to look like, but is it the right time? And these are the 3 points that I look at firstly, and then the next 2 are follow on. So the first one is, where are we in the economic cycle? Are we in the growth phase? Are we in the defensive phase? Are we in an increasing rate cycle phase? Are we in the plateau? Where are we? And what's going to that will influence the type of note. Will it be a growth note? Will it be conditional? Will it be fully defensive and guaranteed? So, if we're in a 2019 happy days, it would be growth. So we need to understand we are on the point in the economic cycle, but not just the point, the length of how long that duration might last. Now, remember, we're structuring these notes for 4, sometimes 5 years, and you're probably not going to be in a growth cycle for 4 to 5 years. You might be. Are you going to be in a recession for 4 or 5 years for defensive? So you need to actually have some crystal balling, but there needs to be an ability to say, right, where are we and how long is that particular cycle? So there's your term. It generally covers more than just one period of time. And I think what's important there is, would that selection of the underlying theme or basket be kind of weatherproof in the current point it is now, and through the inflection point into a new cycle? It needs to be somehow, it can be malleable into two as it changes. You might be lucky enough if it's a growth note, it's a roaring growth for 5 years. But that's something you need to think about. The thematic approach is exactly, what's the cycle of the trend? If we're getting into artificial intelligence, is this like a short-winded thing that's going to last 3 months? Or is it part of the new world? I mean, you've got Bill Gates, you've got, not George Soros, you've got Bill Gates, you've got Elon, you've got all the guys who've been in the tech world saying AI is going to be bigger than the computer when it came onto the world stage. Will it be? Well, time will tell. But at the moment, it seems to be a very popular investment theme for some of the very big tech companies who've got billions and billions to put into these startups and the research and development side. We don't want to be caught in a pandemic type of trap, which obviously exists in terms of what happened in the pandemic was a very strange set of circumstances that certain companies just absolutely skyrocketed in terms of valuations. And then once we went back to the kind of old normal, new normal, people said, well, we don't need that anymore. Let's go and do this way. So valuations have to be, in terms of appreciating how long might sit with those high or low valuations. So depending on 1 to 3, they're quite straightforward. We can then start saying, right, what do we want to put in the note itself, the sort of ball of putty? How much protection do we want? What must the triggers be? How deep must the triggers be? So we start working that with that. So that's really a function of Cashbox with IDAD, and then with our structuring partner, and then with the issuing bank itself. And 5 is actually, it's the shortest verbiage there. And so I suppose along the lines of Goldilocks and the 3 bears, it's almost like, which big bad wolf's going to come out to play when I said that these guys aren't charities. So you need to be very careful and selective about which issuing bank is going to underwrite this. Have they got a track record? Is it their demographic? Is the experience there? Are their credit ratings okay? Et cetera, et cetera. We did a webinar last year in the wake of the banking wobble, if you want to call it that, the nervousness in the US mid-market banks, where a number of them went insolvent. And then obviously a very large global bank in the shape of Credit Suisse went out of play. So we do a lot of work there to make sure that the issuer, the bank that's guaranteeing these terms and conditions, is actually going to be around in 4 to 5 years, or whatever the term of the contract is. So those are 5 big considerations. And no, we can't, none of those we can determine on a pure science, on a pure numbers basis. There's no algorithm that's going to say, how long is this trend going to last? How long is the electric vehicle adoption going to take, or AI, or clean energy, or? We don't know that. A lot of it is sentiment, this fragile notion that's intangible. So let's move on to sort of a little bit of investment 101 now. And pardon me if I'm boring people, but horses for courses has very much been a Cashbox internal methodology, and making sure that we're putting the right type of stocks into the right theme at the right moment. Chad always likes to say, and Chad, I hope you don't mind me saying this, we're not going to put a product into our community if we're not prepared to invest it ourselves. So there must be a horse for every course. And these courses are different, whether it's growth, defensive, cyclical, where are we in the economy, etc. But defensive stocks are generally, and you'll be able to backtrack them to that other slide in terms of, what was being used when there was carnage. It was defensive. There was an opportunity during those times that we would use banks, for example, in rising interest rates in 23 and 22. We did lots with banks. Banks were fantastic to us. When it was growth and interest rates was 0 back in 21, we did infrastructure because people were throwing money at rebuilding. So you have to align the thinking and the timing to the trend and the methodology, and that the numbers stack up. So, growth stocks, obviously they speak for themselves. It's out and out looking for companies that are going to outperform their peers and do very well. cyclical stocks, those are typically they follow different cycles in terms of growth, expansion, growth, peaking, recession, recovery. They go through, but they're all fairly typical. So we've used combinations of these dependent on where the thematics are, where the economic cycle is, what are the geopolitical things coming in, what are the stresses and strains that the bank is thinking about, because sometimes their stresses and strains might be different to ours.